So this is Learning Objective 5. We're valuing and reporting a lot of our investments. And the ones that we're going to focus on in this video will be the stock investments where we own less than 20 to 25% of the outstanding shares. So we would be using the cost method. And our debt investments. What is not part of or won't fall into any of these three categories, the trading, available for sale, and held to maturity. What's not involved here are any equity method investments that we have, and not anything on consolidated financial statements. So we're looking specifically at stock holdings where we have less than 20%, and the various debt investments that we have. Okay, so I'm going to start with trading securities, and this is our first category. And these can be debt investments or they can be stock investments as long as they're less than 20% holding. These are investments that management intends to sell very soon. They intend to sell them in the near term, and the other part of that is that they it's possible for them to do so. In other words, these are actively traded securities that you can sell them, just put a phone call in and sell them if you want to. So they're held in an active trading account. They're bought and sold to make money on short-term price differences. And because they have the intention and the ability to sell trading securities in the near term, we have a special way of accounting for them. I should mention that the trading securities, when we use that, when we're referring to the trading securities, we're talking about what's called a portfolio. And that would be all of the individual securities. When you add them, list them and add them up, you would have an investment portfolio. So when we're making market adjustments, which is what we're going to be doing in this section, we're not going to be doing them to each individual stock. We're going to be doing them to the whole bunch of trading securities. Everything that's classified as a trading security is going to be in that trading securities account, and we're going to just have a fair value adjustment to that account that gets them to the fair value. Okay, because we're going to be selling them in the near future, they're going to be reported on the balance sheet at fair value, which means we do have to make adjustments. And so let's make that adjustment. Let's say that the original cost of our trading securities was $10,000, and the current fair value right now, if we went and looked it up, on Google Finance or whatever, was $12,000. This is what it's on our books for now, is the $10,000. So we're going to, at 12/31 each end of the year, we're going to make a fair value adjustment. And so, accounting being very sneaky, we call it fair value adjustment. That's the name of the account. And we have to say which account we're adjusting, and it is trading. You have to have that there, trading. Okay? So we would adjust this up, the $2,000, to get it at market value. So we haven't adjusted any individual stocks that we own, because that would mess up all the cost bases. But we have our sort of, our entire trading portfolio account, trading securities account. And this is an account that goes with that, similar to you have equipment, less accumulated depreciation, or your accounts receivable, less allowance for doubtful accounts. This is another valuation account. So you have your trading securities, and then this it helps set it to a fair value. Okay, so now we have another side to this, and we haven't sold these securities yet, but we've made, we're better off. So what we have is an unrealized gain. It's unrealized because we haven't sold it. So make sure you put the "un" in there. And it's a gain because we're better off. And then it's where we report it. Even though we haven't sold these, we report them on the income statement. So we say unrealized gain income, $2,000. And that's our journal entry to adjust are trading securities from cost to their current fair value. Okay, so now how does that show up on the balance sheet? You're going to have your trading securities at fair value would be right after, generally pretty much right after cash on your balance sheet in the current assets section. So it would be trading securities at fair value. Unrealized gain or loss income is going to be reported on your income statement under other revenues and gains or other expenses and losses. Okay, so what I have left as an example for you in the notes, some brief exercises that show, demonstrate a little bit more how these are done, and I'd leave you to look at those and let me know if you have questions on them.